Canadian unemployment figures are expected to rise today as the global slowdown in growth gives employers little incentive to add jobs to the Canadian job market. There's also the suggestion that skilled workers from the US, driven out by unemployment at home, are moving to Canada in order to seek employment opportunities there. Talking to me ahead of this data is Colin Cieszynski from CMC Markets Canada. Colin, the unemployment rate is expected to edge back up to 7.3% after dropping to 7.2% in June. Would you agree with these expectations, and what factors are contributing to this anticipated increase in joblessness rates?
It looks as though really the employment rate will probably stay flat, whether it goes up a little bit or down a little bit. But generally speaking, it's looking as though the Canadian economy has held fairly steady through the summertime. We don't have a lot of data out for July yet. The first indication we had was the Purchasing Managers Index, which came out on Tuesday, and it was quite a bit stronger, jumping to 62.8 from 52.0 last month. It does bounce around a lot, but generally speaking, we're looking at things being fairly steady for Canada. The Street is expecting a 5,000 increase in jobs compared with a 7,000 increase in June, and it looks as though that's probably fairly reasonable. We're not just nice steady job growth in Canada, nothing huge like we saw in the spring, but generally speaking, it looks as though the Canadian economy has remained buoyant into the summer.
The unemployment figure has been stagnated around 7% for a while. It's felt that the private sector gains may offset the drop back in the public sector. Would this suggest inefficiencies in government policy, and what more do you think can be done?
What we're seeing right now in Canada is that, like in other countries around the world, there are a number of cutbacks in spending in the public service side. So that's not to be that's fairly normal. We're not to the same extent, perhaps, that we're seeing in countries in Europe, but certainly governments across Canada are tightening their belts and trimming around the edges where they feel it's necessary. With the ability, though, of the private sector to offset this is quite important, because it highlights the underlying strength of the Canadian economy relative to economies in other parts of the world where governments are cutting back and unemployment is skyrocketing. So it's quite a significant difference for Canada, and does indicate that the economy is doing quite well even in a strong dollar environment.
Canada's trade deficit has widened to 1.81 billion Canadian dollars. It's thought that jobs in industries such as manufacturing, transporting and warehousing are set for a dip. Is there a connection here?
There is a little bit. The primary connection is currently through the strength of the Canadian dollar, which has recently climbed back above par against the U.S. dollar, and that does tend to have a bit of a negative impact on the manufacturing sector, just because our Canadian goods become more expensive in the United States and in other export markets, which is a little different than say the resource sectors, where it doesn't matter as much. And then when you ship oil, for example, people will buy oil regardless of where the Canadian dollar is at, but manufactured goods is a little bit different. So it does indicate a continuing trend that we've seen towards, and this has been playing out over a decade, of additional strength in the resource sectors and a bit of weakness in the manufacturing sectors, but this isn't anything new.
You mentioned there the strength of the Canadian dollar. What are your forecasts for the CAD, and what are the major challenges facing this currency at present?
The Canadian dollar for most of the last year has been trading pretty much in a range between about 98 cents and $1.04 on the U.S. dollar CAD, or CAD US dollar 96 cents to $1.02. So if we use the US dollar CAD, or the global standard, so it's back below par. So it's possible we could see it come back down and retest 98 cents over the coming weeks. We're at 99.20 now. The risk on the other side is that it has become a little overextended to the downside. It's fallen off fairly quickly lately, so you could see a correction back up towards par. Or if you did start to see some sort of strengthening in the U.S. dollar, perhaps back up towards the higher end of this trading range.
Colin, thanks very much for joining me once again. Stay tuned for our week ahead interview with Rowena Harris-Doughty. She'll be speaking to Paul Bloxham from HSBC about the economic data releases which could shake up currency markets next week. From me though, goodbye and have a great weekend.